The market has seen a significant sell-off in the last month, and in large part due to the fact the Federal Reserve announced they're expecting fewer rate cuts in 2025. Now, this obviously impacts the entire stock market negatively, but even more so dividend stocks. So in this video, we're going to be looking at 5 dividend stocks that are currently trading right at their 52-week low, and I think actually quite a few of them are at a pretty decent value. So let's go ahead and jump into it. Now, the first stock we're going to look at is going to be one that I own in my personal portfolio, and that is Domino's Pizza, currently trading at $404.71 per share, and over the past year, this company's down by about 5%. And if we take a closer look at just the last 6 months, down about 16.21% and clearly trading right at their 52-week low. Now, one of the things you have to understand about Domino's Pizza is the dividend growth from this stock has been absolutely phenomenal over the past decade. But go ahead and jump over to my dividend breakdown sheet, come up here and plug in Domino's. Here's what we can see. And like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description and get a 7-day free trial. Now, we can see, yes, the starting dividend yield for this company is sitting at about 1.5%. But look at that 10-year dividend CAGR. It's sitting close to 20%, and the 5-year really hasn't slowed down much, sitting at 18.36%. So the dividend growth history from this company has been absolutely phenomenal. They've gone from about 80 cents per share in 2013 all the way up to $4.84 in 2023, and right now sitting close to about $6.04. And all this dividend growth has been backed by growing free cash flow. And because free cash flow is growing at such a healthy rate, we can see the free cash flow payout ratio has stayed in a very healthy range. Remember, if a company's going to be able to grow their dividend at a high rate over the long term, then we probably want to see a free cash flow payout ratio of below 40%. Now, if we jump over to our stock screener for Domino's, come up here and plug in DPZ, what we can see is the past decade has been phenomenal for this company. The earnings have absolutely exploded, and if you look at how the share price has evolved over the past decade, you're going to see the share price has certainly followed the earnings. They've way outperformed the market, up about 311%. And if we look at forward-looking guidance for this company, we can see they're expecting about 7 to 8% earnings growth moving forward. So they're projected to continue to grow at a pretty healthy rate, and we'll come back and talk about that here in just a moment. But here's the problem a lot of people have with Domino's Pizza right now. It's the balance sheet. It's their debt levels. If we go ahead and jump over to my balance sheet breakdown, come up here and plug in Domino's. If we come over here and look at the current ratio, it's sitting at 1.71. That's very healthy. Typically for most industries, you want to see a current ratio of above 1, meaning total current assets is above total current liabilities, meaning they can easily meet short-term obligations. But here's where people actually have the concern. It's not in the short term, it's in the long term. Look at the debt to assets ratio, sitting at 2.93. This is simply total debt divided by total assets. And we can see total debt sitting at $5.2 billion when total assets is only $1.7 billion. So there's a lot of long-term debt on the balance sheet. So the question boils down to this: how are they going to be able to manage the long-term debt? Because poorly managed debt levels can lead to the downfall of the company. That sounds dramatic, but it's true. So here's what we really want to pay attention to. If we come over here, look at the interest coverage ratio. What this is a ratio telling us how easily a company can meet its interest obligations on outstanding debt. All it is earnings before interest and taxes divided by interest expense. So right now we can see for the last decade, their earnings before interest and taxes has been about 4 times higher than their interest expense. That's considered healthy, and the fact we haven't seen a lot of fluctuation in this number is a very good sign. And in fact, if we look closely at the past 3 years, we can see it's continued to climb higher and higher. So the large levels of debt isn't actually anything new for this company. If we look at the debt to assets ratio over time, it's been high, and during that time period, they've way outperformed the market because they've been able to manage that debt. So when I think about Domino's Pizza's debt levels, yes, this is certainly something to keep your eye on if you're interested in this stock or if you're a shareholder, but you have to acknowledge the fact they've done a very good job of managing the debt over the past decade. If they can do the same for the decade moving forward, I don't think this is something to be concerned about. So now the big question for Domino's, are they trading at a good value right at their 52-week low? And Domino's presents an interesting scenario when it comes to their valuation, and I'm going to show you why here in just a moment. But to break this down, we're going to be looking at Bogle's valuation. It's a very straightforward and simple valuation, but it makes a lot of sense in the case of Domino's Pizza. To start off, let's come up here and plug in Domino's stock ticker. Again, thanks to ticker data, the data will automatically load in. Now, with Bogle's valuation, what it does is it doesn't give you a specific intrinsic value, a buying price. But what it does is it can tell you what your expected annual return should be. And it does this by taking into account earnings growth, plus shareholder yield, plus minus multiple expansion. So let's account for each of these. Like we've already seen, the management team has told us they expect about 7 to 8% earnings growth moving forward for the next few years. So if we jump back over to Bogle's valuation, let's just go with the middle point, maybe about 7.5% when it comes to earnings growth. Now we need shareholder yield. We need to add the shareholder yield to the earnings growth. And what shareholder yield is it's simply dividend yield plus buyback yield. We have to remember there's 5 different ways to use free cash flow for a company to use their capital. And the 2 ways that directly reward shareholders are going to be paying out dividends and buying back shares. So both of those combined is going to be shareholder yield. And we've already talked about the dividend. It's sitting at about 1.5% when it comes to the yield. But what about the buyback yield? What percent of outstanding shares are they constantly buying back? If we come down here and look at weighted average shares outstanding, we can see the company's actually buying back a pretty significant amount of their outstanding shares on an annual basis. In fact, the average buyback yield for this company is close to 3.5% over the past 5 years. They've been buying back a lot of stock. So let's just assume it's going to be even lower. Let's assume about 2.5% on the buyback yield. So we're putting them on the low end. We can see we still come to a shareholder yield of 3.99%. So that gives us a shareholder yield of right at 4%. So if we add these two together, we get an expected return of about 11.5%. But now we have to take into account multiple expansion, or actually in this case, what some would argue would be multiple contraction. Let me show you what I mean. If we jump over to Seeking Alpha, we can see the price to earnings ratio for this company is sitting at about 24. That's relatively high. It's even higher than Google stock. And again, all this is telling us is how much people are willing to pay for each dollar of earnings. And the argument I'm starting to see from more people is that in the future, people are going to be willing to pay less for each dollar of earnings for Domino stock. So let's assume an absolute worst case scenario for Domino's. Let's assume over the next decade, investors are going to be willing to pay about 20% less for each dollar of earnings. So the price to earnings ratio will be reduced by about 20%. We can take that into account with Bogle's valuation. So assuming we're looking at the next decade of annual returns and the price to earnings ratio is going to reduce by 20%, that'd be negative 2% reduction in the multiple every single year. Where we actually see multiple contraction over the next decade, your expected return would still be close to 9.5%. But what about a best case scenario? Well, if we jump back over to Seeking Alpha and look at the valuation, if we look at their price to earnings ratio right now sitting at 24, we can see their 5-year average is actually sitting closer to 30. So their price to earnings ratio right now is about 20% lower than what it has been on average over the last 5 years. So let's look at the opposite of this. Over the next decade, let's say we see the multiple increase by 20%. That'd be 2% on an annual basis. Your expected return jumps all the way up to a massive 13.5%. So I definitely think Domino's is one of the more interesting opportunities on the market right now. The second stock that is trading right at its 52-week low is Nike, stock ticker NKE, trading at $72.03. And if we look at the past year, they've been absolutely hammered, down over 30%, and they've brought on a new CEO. Now, perhaps the most interesting thing going on with Nike stock is the big move that hedge fund manager Bill Ackman recently made. He increased his Nike position by about 435%. It now makes up about 11% of his entire portfolio. And if we look at Bill Ackman's buying history, he's now actually bought Nike stock for 2 consecutive quarters in a row, and his average buy price is about $81.20 per share. So the current share price is actually a little bit lower than Bill Ackman's average buy price. You can get in lower than Bill Ackman did. Now, one of the things we have to understand about Nike is, historically speaking, this has been a phenomenal dividend growth stock. If we come up here and plug in Nike, what we can see is the starting dividend yield for Nike is currently sitting at about 2.2%. So not the highest starting dividend yield, but here's one of the things you have to understand. If we look at the dividend yield history for Nike, jump over to Seeking Alpha and scroll down, zoom out and look at the last 10 years. This is now the highest starting dividend yield this company has had in the past decade, and this is due to 2 reasons. Yes, we've had a massive sell-off, which has led to a higher starting dividend yield, but look at how fast this company's been increasing their dividend payments over the past decade. Close to about 11% 10-year dividend CAGR in the 5 years, sitting close to 10%, all while maintaining a low payout ratio. So pretty much the dividend metrics check all the boxes that we want to see. Now, if we jump over to the stock screener, come over here and plug in Nike. If we come down here, we can see over the past decade, revenue per share has grown from about $15.73 to in 2024, about $33.84. But here's what spooked a lot of investors. The management team at Nike stated that in 2025, you could expect revenue to be about 10% lower than it was in 2024. So that's a pretty dramatic decline. Now, if we look at earnings, we can see it's been a little bit stagnant since 2021. Not a lot of growth, but we can definitely expect earnings to decline in 2025 along with revenue. In fact, if we jump over to Seeking Alpha and look at the earnings estimates over the next few years, we can see it's not going to be until 2028 when analysts projects that earnings per share will recover back to where it was in 2023. So the company definitely has a recovery ahead of them. But with that being said, has this recent sell-off been too overblown? Has the sell-off been too much? Well, Well, one of the things we can do is actually use a Charlie Munger method with inversion. We can look at a reverse discounted cash flow analysis to see how much free cash flow growth is currently priced into Nike stock and analyze if we think that's accurate. So we'll come up here and plug in Nike. Again, all the data will load in thanks to ticker data. Now again, we want to see how much free cash flow growth is priced into Nike over the next decade. So what we're going to do is we can see as of right now with 0% free cash flow growth priced in, the market is telling us Nike's worth about $58 per share. Now, if we bump up the free cash flow growth rate projection to 1%, it jumps up to 62. Bump it up to 2%, 67. At 3%, $72. The current share price for Nike is sitting at $72. So what the market is telling us is there is only 3% annual free cash flow growth priced into this stock over the next decade. That's a very low number. Now, I will be fair. Yes, I do know free cash flow is going to decline dramatically over the next year and take a little bit of time to recover. But I would still argue that this growth rate is on the low end. Now, whether or not Nike's trading at a good value depends on one question. If you think free cash flow growth will be higher than this over the next decade, then Nike stock is a good opportunity. If you think it'll be lower, then Nike stock is currently overvalued. Next on our list, we have PepsiCo, stock ticker PEP, trading $144.61 per share. And this company has been around for a very long time. Now, over the past year, they're down about 13.37%, and we can see a lot of the sell-off really started around mid-October. They were trading as high as $176 per share, so the sell-off has been pretty intense during that time period. Now, if we look at them from a dividend perspective, come up here and plug in Pepsi, we can see this company now has a starting dividend yield sitting at 3.7%. And just like Nike, this is one of the highest starting dividend yields this company has had in a very long time if we look at the past decade. So you have a chance to buy into Pepsi stock at its highest starting dividend yield in over a decade. And along with that, you can see the 10-year dividend CAGR at 7.7% and the 5-year dividend CAGR at about 7% and a great history of dividend growth. Now, the caveat we do have to make note of is look at the free cash flow payout ratio over the last year, sitting at about 84%. So the company is using the vast majority of its free cash flow to pay out dividends, leaving not a lot of capital left over to do things like reinvest back into the business. Now, that is more typical for mature companies like Pepsi, but this is still a little bit on the higher side. Well, if we go ahead and jump over to our stock screener, come up here and plug in Pepsi. Now, what we see is probably what you would expect from a more mature company. They are growing, but growth rates aren't very high. Same is true with earnings, and the same is true with free cash flow. But something you probably haven't realized about Pepsi is they actually have pretty high margins for the industry that they operate in. Last year, the gross profit ratio was sitting at 54.21%, while the 10-year average is 54.28%. So it's a good sign to see the high gross profit ratio and that it's remained unchanged over the past decade. You could argue that's a sign of a competitive advantage. But let's talk about the valuation for Pepsi. If we go ahead and jump over to my stock valuation sheet, come up here and plug in Pepsi. And there's two valuations that I do want to point out with this stock. But before we do that, look at the beta. Only sitting at 0.54. So if you're looking for a stock with very low levels of volatility, Pepsi could be a good option. But the first valuation we're going to look at is going to be the historical multiples valuation. And what we're doing is we're looking at how the market has historically valued this company over the past decade. So we can see how the price to earnings ratio has changed throughout the past decade. And on average, over the last 10 years, the average PE ratio was 25.21. For the trailing 12 months right now, it's sitting at 21.23. That's about a 16% difference. So compared to how the company has historically traded, they look 16% undervalued. Now, if we look at them from a dividend discount model perspective, we're valuing them based on how much they're paying out in dividends and how much that dividend will grow in the future. And assuming a dividend growth rate of about 4.75%, which again, keep in mind, is a little bit lower than their 5 and 10-year averages, but the free cash flow payout ratio has been climbing over the last few years, likely meaning lower levels of dividend growth moving forward. But with that being said, even with a 4.75% dividend growth rate projected, the dividend discount model price per share would be about $171.79, again indicating about an 18 to 19% undervaluation of Pepsi stock. Next on our list, we have the popular REIT, Realty Income Corporation, stock ticker O, trading at $51.95 per share, and over the past year, they're down about 12%. But look at this. In mid-October, they were trading as high as $64.71. So up to that point, 2024 had actually been a pretty good year for the company. But the sell-off has been pretty dramatic since that point, all the way down now to $51.95 per share. But the good news is they now have a starting dividend yield sitting at 6.13%, so a massive starting yield for this company at these current prices. And again, this was around the time when the Federal Reserve started to hint that maybe interest rates wouldn't come down quite as fast as investors were expecting. Now, if you're not familiar with Realty Income, here's a couple key things you need to know. First off, this company is known as the monthly dividend company. If we look at the dividend history for this company over the past decade, you can see every single month, like clockwork, they're going to pay you a dividend. And they don't just increase their dividend payments on an annual basis, they actually increase their dividend payments on a quarterly basis, and they've been increasing dividends for over 27 consecutive years. All those are very impressive metrics for REITs. So, for example, in 2020, a lot of REITs did have to cut their dividend. That was not the case for Realty Income. Those monthly dividend payments kept happening. And if we look at the dividend growth history for this company, scroll down, we can see the 5 years, pretty good for a REIT at about 3.5, the 10-year at about 4%, and the 3-year, 4.18%. So right now, we can see a history of growing dividends, paying them on a monthly basis, with a very nice starting dividend yield right now. But how sustainable are those dividend payments? Well, we have to remember with a REIT, we don't look at typical payout ratios. We want to pay attention to the AFFO payout ratio, adjusted funds from operation. And for Realty Income, it's sitting at 75.11%. Now, why can't we look at the typical earnings payout ratio? Well, we have to remember REITs are required by law to pay out 90% of their earnings in the form of dividends. So again, we want to pay attention to adjusted funds from operation payout ratio. Now, something you also have to know about most REITs in general, and specifically Realty Income. If we jump over to our stock screener, come back over here and let's plug in stock ticker O. If we come down here, we can see shares outstanding. And again, because this is a REIT, they're required by law to pay out 90% of their earnings in dividends. So in reality, they have two ways that they can grow the business. One, they can take on debt. And number two, they can issue more shares. And because interest rates were so low from around 2013 to around 2021, obviously it made more sense to take on debt. But as interest rates have climbed over the last few years, you can see they have elected to issue new shares outstanding, which, keep in mind, will dilute you as a shareholder. Now, this is pretty typical for REITs, but it is something you have to be aware of. Now, if we look at this company from a dividend discount model perspective, assuming just 3.25% dividend growth, which is a little bit lower than we've seen over the last few years, the company's worth about $61.62 per share, which is about 18 to 19% higher than the current trading price for this company. And then finally, we have SJM, the J.M. Smucker company, down over 20% in the last year, currently trading at $101.97 per share. If we go ahead and look at this company from a dividend perspective, come up here and plug in SJM, and we can see right now this one has a pretty high starting dividend yield, sitting at about 4.2%, and the 5-year dividend CAGR at about 3.75%, and the 10-year at 5%. So, decent combination of high starting dividend yield with some dividend growth. But here's the big concern. Look at the free cash flow payout ratio over time. Starting out in 2014, it was only sitting at about 41%, and in 2016 as low as 25%. But look at how much this has climbed over the last 3 years, going to 58%, going to 60%, going all the way up to about 68%. And if we look at the free cash flow versus dividends paid out, we can see in 2024, they did about $643 million in free cash flow and dividends paid out, sitting at $437 million. So 68% of the company's free cash flow was being used to pay out dividends. That number has continued to increase over the last few years, which is a little bit of a concern. If we jump over to our stock screener, come up here and plug in SJM. What we can see is revenue has been growing a little bit, but it's been somewhat stagnant, and the same is true with earnings per share. Now, if we look at the free cash flow yield for this company, is sitting very high actually. It's about 8.42%. So for every $100 you invested into the company would generate about $8.42 in free cash flow. That's considered a pretty high starting free cash flow yield. But remember, in an ideal world, a company would grow your free cash flow yield on cost because they're growing free cash flow. And my concern with this company is they're not really growing free cash flow at a healthy rate. In fact, it's quite a bit lower over the past 3 years than it was the 3 years prior. But nonetheless, if we go ahead and jump over to the valuation for this company, we'll plug in SJM. And to start out, if we look at the company from a discounted cash flow analysis perspective, we'll go ahead and zoom in. We can see if we assume about 5% free cash flow growth moving forward, which could be on the high side to be honest, the company's worth about $93.50 per share, which is still below their current trading price. If we look at the historical multiple valuation, what you'll see is we have to remember valuation is an art, not a science. We obviously have a huge outlier here in 2023 when the company had negative earnings, so we'll need to remove this metric. But after that, here's what we can see. The average PE ratio over the last decade is about 21.42. Trailing 12 months, it's sitting at 20.63, so it's pretty much right in line with the average, meaning the company's actually pretty close to being traded at fair value despite the recent sell-off. And then finally, if we look at them from a dividend discount model perspective, assuming a dividend growth rate of 4%, which again, to be honest, could be on the high side if that free cash flow payout ratio starts to climb, we could see we come to an intrinsic value of $111, which is about 9% higher than the current share price. So all in all, when I look at this company, I do think there are some problems. Revenue growth is slow, earnings growth is slow, and that's going to hinder dividend growth in the future. This one's actually probably trading pretty close to fair value, and I think the sell-off is justified. So go ahead and let me know what you think of these 5 companies in the comments down below. And like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.